morning. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy. I'm a financial advisor with Kentucky Planning Partners, joined with my colleague, Ben Hopper.
Good morning, everybody. Thanks for joining us. We look forward to talking with you here.
And what are we talking about today, Ben?
Roth conversions. So this is a topic that is a little more into the weeds on a couple of things as it relates to retirement planning, and specifically traditional pre-tax versus Roth dollars, and what the difference is and what a good strategy could be for some people.
So in this show, we're going to talk generally just really what is a Roth conversion. And as all things are considered, remember, we're not here to give tax advice. Anytime that you're deciding whether a Roth or traditional IRA is best for you, whether the tax consequences of converting from an IRA to a Roth is best for you, make sure you are consulting your tax professional and that you're doing so in the space of a comprehensive financial plan. Make sure you understand why you're doing these things and how they work for you. So that's always most important. So first and foremost, Ben, what is a Roth conversion?
So a Roth conversion is a strategy whereby you have pre-tax dollars, maybe in a 401k plan, maybe in a traditional IRA that has not been taxed yet. And a Roth conversion simply makes some of those funds, it converts to Roth to where it's tax-free. So you've heard about us talking on the show before about the difference between Roth and traditional. The very high level, again, just to reiterate, is that traditional dollars are pre-tax. They have not been taxed by the government. You got a tax benefit whenever those went into your account. Then the Roth, on the flip side, is after-tax money. You did not get the tax benefit when the dollars went in, so all of that money gets to grow tax-free from there. So we often say that pre-tax dollars might be tax-infested, because if you had $1 million in a 401k account that's all pre-tax, well, as of right now, that about a third of that is actually the government's, right? So Roth,
depending on your tax bracket.
Depending on the tax bracket, that's right. So Roth, that big sum of money, is all been taxed, is all after tax and tax-free to you now.
And the analogy that we've often used, it comes from our CEO, Rob. Rob has used this beautifully, and we use this with most of our clients, is that a traditional IRA or a 401k, if we imagine that your retirement asset is like a harvest that you're going to reap in retirement, and the investments that you make are the seeds that you're planting to reap that harvest. Well, what would you rather pay taxes on? The small seeds that you plant year in and year out? Or would you rather pay taxes on the very large harvest? Well, most people would say, I would rather pay taxes on the small seeds. A 401k or traditional 401k, pre-tax 401k, and an IRA, you don't pay taxes on the seeds. But when the harvest comes due, every distribution you take in retirement from those types of accounts is fully taxable. Whereas with a Roth, you pay taxes on the seeds, and then the harvest is fully tax-free upon distribution, and you don't pay tax on those.
That's right.
So
specifically, when we talk about a conversion, when might a conversion of pre-tax or traditional to Roth make sense? Well, again, it's very situation specific, which means your personal situation and your tax situation will determine that. So this is one of the areas where we might work with somebody's accountant, and we might have conversations with them, and the accountant will give us the direction that says, hey, KPP, you all should probably look with this client at doing a Roth conversion for this amount. We would actually get that from the tax advisor, and then we can execute it. But one situation where it might make sense is a recently retired individual. So it might be where, say, you're 60 years old and you go ahead and retire. Well, when you retire, your income's going to fall, right? It might go from $100,000 a year to zero if you're not earning any income, for example. And in that situation, when your tax bracket falls, that could be a good time over the next few years, early in your retirement, to start converting some of those pre-tax dollars into Roth. Because whenever you make that conversion, you're going to owe a tax on that. Your tax is going to be determined by your current tax bracket and your tax rate. So if you're not earning income because you just retired, that conversion could be taxed at a very low rate.
But remember, if you haven't paid taxes on 401k or IRA dollars, those distributions that come out of those accounts would be taxed at your ordinary income level. and the amount of money that comes out of those accounts will determine what tax bracket you're in. So again, working with your accountant on this, as advisors here, we'll partner with our clients' accountants to make sure that we understand what their AGI will be and what it would be based on certain distributions, and only with their guidance will we make those distributions and working with them to do that. So it's really, really important to have a team to make sure you're crossing every T and dotting every I to maximize the amount of money that remains yours and reducing potentially that tax bill that you have to pay to Uncle Sam.
That's right. So why are we talking about this? What's an ultimate reason as to why we would do Roth conversions? I think is a very important question. And one of them has to do with the required minimum distribution rules. So RMDs, you've probably heard us talk about that if you've tuned into our show, but when you turn 72 under today's rule, by April following the year you turn 72, you have to take out your first required distribution from any pre-tax accounts. So traditional IRAs, 401ks, it hasn't been taxed by the government yet, so they say once you turn 72, you have to start taking a distribution every year. However, if you have some of that money in Roth, those are not subject to RMDs. So you do not have to take forced distributions from the IRS for any Roth dollars.
So with those RMDs, another way of thinking about it, it's a beautiful explanation, is you never pay taxes on those dollars, and at some point the bill comes due. So an RMD is a required minimum distribution, required amount that you have to take out of those investments on which you've never paid taxes. Take a distribution, pay taxes on that, and then you'll have the rest as after-tax dollars. Again, where the Roth, you don't have to take RMDs. What about at death? What happens at death and the difference between an IRA and a Roth?
That's exactly where I was going to go next. So
great minds think alike, Ben.
That's right. For inheritance. So if you're wanting to think about how you're going to pass money to beneficiaries, your sons, your daughters, your grandchildren, Roth dollars tend to be a little bit more favorable from a tax perspective because it has to do with the same rule of thumb that if beneficiaries inherit pre-tax accounts, well, they're going to have to start taking distributions and they're going to have to start paying taxes on those dollars now. So if a beneficiary inherits a pre-tax IRA under today's rule, in many cases they're going to be subject, not every case, but in many cases they're going to be subject to withdrawing those funds within 10 years. So again,
or incur penalties.
Now a Roth beneficiary does have distribution rules as well, but they are not quite as stringent, I guess, as the pre-tax rules. So Roth beneficiaries get to inherit that money tax-free, and your beneficiaries then don't have to pay taxes on those dollars because you already did.
So a Roth conversion effectively takes those IRA dollars that you haven't paid taxes on, and again, if it's just to pick a general number, if you have $100,000 in a 401k or IRA and you're retiring, well, the sooner you realize that a portion of those dollars is the government's, because when you take distributions, you'll have to pay taxes on them, the sooner you'll come to grips with really what's yours in that account balance. But what a Roth conversion does is you incur that tax, not penalty, you incur the tax bill of paying down those assets, making them all yours, and converting them into a Roth, which is something you'll never have to pay taxes on again, for the most part.
Yeah. Now, a couple of situations, a couple of quick reasons as to why you might not want to do a Roth conversion. One would be if you're going to need those particular funds within 5 years. So if you do a Roth conversion, you then get subject to the Roth IRA rules on that sum of money, which says you have to wait 5 years to access the funds. So say you're in retirement and you know that you're going to have to start taking those funds, that might not be a good time to do a Roth conversion. If you don't need the funds for a longer period of time, that would be a better reason why to do a Roth conversion.
What if you already have Roth assets? Are you able to access the pre-existing Roth assets, or is it all Roth dollars, or is it just those that you convert?
Just those that you convert.
Okay. So there are still ways to do a conversion for somebody in retirement, but you just have to make sure you're working with a professional that understands from which dollars you can draw income.
That's right.
Okay.
Another reason why you would not want to do a Roth conversion is if for some reason you think that your taxes, your tax bracket that you'll be in is higher right now than it will be in the future. That's the case for some people, not everybody. But if you're going to lock in the tax that you owe now on the Roth conversion, but you know it's going to be lower in the future, then it would make sense to maybe wait or not do it, just from a tax perspective. But again, we aren't accountants, and this is where we would have to partner with a CPA, partner with an accountant to determine if it makes sense for a client.
But when we're building financial plans for clients, we're always able to look at their accounts and look at the assets that they have and see their entire financial picture. And it's oftentimes we'll say, you know what, you may be a really good candidate for a Roth conversion. Let's connect with your CPA and make sure we go down that path to ensure whether or not you are. So one of the advantages of building a financial plan and working with a team and surrounding yourself with really smart people. I was taught when I was as a young man that you're only as good as the best friends that you surround yourself. And I'm really fortunate to be surrounded by really smart people. But that's really the key to having a financial plan and working with a financial team to make sure you're not missing out on any opportunities that could work for you. And make sure every dime is working together to help you realize the life that you've earned. So whether it's Roth conversions or general retirement questions, give us a call at KPP. We'd be glad to help you. If you don't have a financial plan or would like a second opinion, we are currently taking on new clientele. Our phone number is 502-394-0400. Our office is located in the heart of Louisville's east side on the corner of Hurstbourne Lane and Shelbyville Road. And check out some of our other videos because it shows you that we do have the best view in all of Louisville. So on behalf of Ben and I and everybody here at Kentucky Planning Partners, thank you for watching. We look forward to seeing you soon. Bye-bye.